Most people think the reason their money disappears is that they are not careful enough. Sometimes that is true, but often the deeper reason is that they are living inside a system where the paycheck grows slowly, prices move quickly, and time punishes money that stays idle. That is the part people feel before they can explain it. They go to the grocery store and the same bag of food costs more. They look at rent, insurance, gas, subscriptions, and loan payments, and everything seems heavier. They work the same hours, sometimes even more hours, and yet the paycheck does not feel stronger. That feeling is not imagination. It is a structure. Your paycheck is linear. You work 1 week and you get paid for 1 week. Then the next week, you have to do it again. Your labor resets every pay period, but the cost of living does not reset for your benefit. Prices accumulate, inflation accumulates. Interest rates change the cost of borrowing. The system keeps moving. This is why a small weekly investing habit can be more powerful than it first appears. It does not look powerful in the beginning. $35 a week looks almost laughable to someone who is trying to build real wealth. $5 a day does not feel like a financial strategy. It feels like a coffee, a snack, a delivery fee, a few things that disappear without a trace. But the same small amount repeated into ownership can become something very different. That is the first principle. The size of the first deposit matters less than whether the habit survives long enough for compounding to become visible. Most people stop too early because they judge compounding at the stage when it is supposed to look weak. They invest a little, look at the balance, and conclude nothing is happening. The account moves slowly and the mind wants proof. It wants fast evidence. It wants the money to feel meaningful right away. But compounding does not move in a straight line. It moves in a curve. The early part of the curve is boring. The middle begins to show weight. The final stretch is where the numbers start moving in a way that seems impossible to the person standing at the starting line. The mistake is judging the curve before it has had time to bend. This is why weekly investing matters so much. It gives ordinary people a way to use time instead of being used by it. It turns a small piece of a paycheck into a small piece of ownership again and again until the ownership itself begins to matter. The source example begins with inflation because that is where real people feel the pressure. Since 2020, food prices climbed year after year. The document describes increases of 3.45%, then 3.94%, then a painful 9.95% in 2022, followed by 5.76% in 2023, 2.26% in 2024, and 2.45% in 2025. Put simply, $20 of groceries in 2020 cost about $25.32 by 2025. That is not just a number. That is a warning. It means money that sits still is not actually safe in the way people imagine. The amount printed on the dollar does not change, but what the dollar buys does change. Inflation does not need to knock on your door and ask permission. It simply makes every future purchase require more dollars. That is the second principle. Inflation does not have to take money out of your account to make you poorer. It can reduce what the account can buy. At the same time, borrowing became more expensive. Rates that were near zero in 2020 moved to around 4.09% by late 2025. According to the document that makes mortgages, car loans, credit cards, and other debts feel heavier. A payment that seemed manageable in one rate environment can become a burden in another. Then wages try to keep up. The document describes year-over-year wage growth around 3.8% in 2025. That may sound positive, but it barely keeps pace with short-term inflation and does not erase the full rise in prices since 2020. So a worker can get a raise and still feel behind. That is the trap. A paycheck can rise in number while losing ground in purchasing power. This is why assets matter. If a paycheck grows at 3 or 4% and a long-term portfolio has the potential to grow much faster over decades, then the portfolio is not just a side project, it becomes the second engine. The paycheck keeps the household alive. The portfolio changes the direction of the household. That is the third principle. A paycheck can pay the bills, but assets can change the balance of power. This does not mean labor is unimportant. Labor is the first engine. Without income, most people cannot invest at all. But if every dollar from labor is consumed by rising costs, the worker never builds capital. And without capital, time remains an enemy. The purpose of investing is to make time work on your side. Weekly investing is powerful because it is realistic. Most people do not receive one large pile of money and wonder where to put it. They receive income in cycles, weekly, bi-weekly, monthly. Their bills arrive in cycles. Their life moves in cycles. A weekly investing plan matches the rhythm of real life. You do not need to predict inflation. You do not need to call the market bottom. You do not need to know whether the next week will be calm or chaotic. You only need the habit to continue. If prices rise, your money participates. If prices fall, you buy more shares at lower prices. If the market crashes, the weekly deposit continues buying into fear. If the market recovers, the shares bought during fear begin working. That is the fourth principle. In an unpredictable system, the most valuable behavior is the one you can repeat. The source points out that the market has lived through the Great Depression, the dot-com collapse, the 2008 financial crisis, the COVID crash in 2020, and the inflation-driven decline in 2022. Each crash felt different in real time. Each one made investors feel like this time could be the end. But the long-term trend still moved upward. That does not mean the future is guaranteed. No market history is a contract, but it does show a recurring pattern. Productive assets can recover from crises if the underlying economic system continues adapting, innovating, and producing cash flows. The investor who waits for a world without fear will almost never invest because the world always offers a reason to be afraid. The fifth principle is this. The market rewards long-term participation, not emotional perfection. You do not need to know every crash in advance. You need a system that does not stop when crashes arrive. Now look at the small snowball. Imagine someone invests $20 a week. That is only $1,040 per year. Most people dismiss it because the number looks too small. But in year one, that money begins forming the base. With normal growth and reinvested dividends, the account starts to move a little. Nothing dramatic happens. By year three, total contributions reach $3,120. With dividends reinvested and early deposits growing, the balance may sit around $3,750. That extra amount did not come from more work. It came from the first small proof that capital is beginning to work. By year five, total contributions reach $5,200, but the account may be closer to $6,850. The snowball is still not huge, but it now has weight. Each new deposit lands on a larger base. Each dividend buys more ownership. Each piece of ownership can create more future dividends. The first 5 years do not look explosive because they are not supposed to. They are the runway. That is the sixth principle. The early years of compounding are not the reward. They are the foundation that makes the reward possible. This is why people struggle psychologically. They are wired to expect quick wins. When the account barely moves, they think the plan is not working. A market drop feels like a warning. A recession headline feels like a reason to pause. A volatile week feels like proof that maybe they should wait. But this is linear thinking trying to judge a nonlinear process. The real mindset shift is simple. Stop asking whether the account grew enough this week. Ask whether you invested this week. That question changes everything. You cannot control the market's weekly return. You can control whether the weekly deposit happens. You cannot force the portfolio to become impressive in year one. You can force the habit to survive year one. That is the seventh principle. The first battle is not with the market. It is with your need for immediate proof. Once that mindset is in place, choosing investments becomes easier. Instead of looking for the perfect pick, you look for qualities that can last. Diversification, broad exposure, real historical performance, dividend growth, low fees. Diversification means owning many companies instead of depending on one. If your money owns hundreds or thousands of businesses, one failure does not destroy the plan. Some companies struggle, others grow. The portfolio survives through the group. Broad exposure means owning different types of companies, not only many names, large companies, mid-sized companies, growth companies, income companies, different sectors, different styles, markets rotate. Some years large caps lead, some years mid caps lead, some years dividend companies matter more, some years growth dominates. A balanced portfolio keeps you from needing to guess every rotation. Historical performance matters because you want real business growth, not hype. You want funds connected to companies with earnings, dividends, and durable fundamentals. Dividend growth matters because rising dividends can strengthen the compounding loop. A dividend buys more shares. More shares can create more dividends. If dividends grow over time, the income stream can become more powerful. Low fees matter because fees are a permanent drag. A small annual fee does not look threatening in 1 year, but over decades it compounds against you. The less you lose to fees, the more remains in the portfolio to work. That is the eighth principle in compounding. What you keep matters as much as what you earn. The Fidelity portfolio in the source is built around these ideas. The first fund is FZROX, the Fidelity Zero Total Market Index Fund. It is the core. It gives broad exposure to the U.S. stock market across large, mid, and small companies. It spreads ownership across major sectors. It has zero management fees. The document describes it with a 1.04% yield, 7.55% dividend growth, and 13.5% annual price appreciation. The job of FZROX is foundation. A foundation should not be exciting. It should be durable. It should be broad. It should keep the investor from chasing every new story. A total market fund gives ordinary investors ownership in the system without requiring them to pick each winner. That is the ninth principle. The core of a portfolio should be boring enough to survive your emotions. The second fund is FSMDX, the Fidelity Mid-Cap Index Fund. This fund focuses on mid-sized companies. These businesses are usually more established than small startups, but may still have more room to grow than the largest corporations. The document describes it as holding around 300 companies across technology, industrials, consumer sectors, and finance. It is described with a 2.42% yield, 17.21% dividend growth, and 7.4% annual appreciation. The job of FSMDX is expansion. A portfolio that owns only the biggest companies may miss some of the companies that are still climbing. Mid-cap exposure gives the portfolio another growth engine. The third fund is FITLX, the Fidelity U.S. Sustainability Index Fund. It invests in companies screened for environmental, social, and governance practices with exposure to areas like technology, healthcare, and communications. The document describes it with a 1.14% yield, 13.74% dividend growth, and 13.06% annual appreciation. The job of FITLX is modern growth exposure. The economy changes, consumer preferences change, technology changes, capital flows change. A fund like this adds a future-oriented layer. The fourth fund is FGRIX, the Fidelity Growth and Income Portfolio. It invests mostly in high-quality large companies with stable earnings. It aims to combine reliable dividend payers with consistent growers. The document describes it with a 3.13% yield, 19.68% dividend growth, and 8.17% annual appreciation. The job of FGRIX is balance. Income without growth can stagnate. Growth without income can be volatile. A fund that combines both can make the portfolio easier to hold. The fifth fund is FDGFX, the Fidelity Dividend Growth Fund. It focuses on companies with long histories of raising dividends and strong fundamentals. The document describes it with a 3.2% yield, 18.03% dividend growth, and 2.78% annual appreciation. The job of FDGFX is income stability. It is not designed to be the fastest part of the portfolio. It is designed to strengthen the compounding of dividend income year after year. That is the 10th principle. Every fund in a portfolio should have a job. If you do not know the job, you do not know why you own it. The source then treats these 5 funds as equal slices. That makes the math simple. Add the dividend yields 1.04, 2.42, 1.14, 3.13, and 3.2. The total is 10.93 divided by 5, and the average portfolio dividend yield is about 2.19%. Using the same simple method, the source gives an average dividend growth rate of 15.24% and an average annual share price appreciation of 8.98%. These numbers are powerful. They are also not guarantees. This distinction matters. A projection is not a promise. Funds can underperform, dividends can change, markets can fall, future returns can be lower than past returns, taxes can reduce what the investor keeps, behavior can damage the result. But projections are still useful because they reveal how the machine works if the assumptions are reasonably favorable. That is the 11th principle. A projection should motivate the habit, not replace risk management. Now look at Josh. Josh contributes $5 per Dalton Y. That equals $35 per week because the portfolio has 5 funds. The example imagines about $1 per Dalton Y going into each fund. That is intentionally small. It is the kind of money most people lose track of, but when it becomes a daily ownership habit, it starts behaving differently. By the end of year 1, Josh contributes about $1,825. This is not life-changing yet. It is the start of the base. By year 10, the portfolio is projected to reach about $32,000 with reinvested dividends beginning to build momentum. By year 20, Josh has contributed $36,500 in total. The long-term compounding pushes the projected portfolio to about $160,000, generating nearly $9,000 per year in dividends. Then the final decade arrives. That is where compounding becomes visible to everyone. By year 30, the portfolio is projected to reach about $942,000. The document describes it as paying around $98,000 per year, or about $8,000 per month. In dividends alone, the most important number is not only the ending balance, It is the gap between what Josh contributed and what the portfolio became. Over 30 years, Josh contributed $54,750 out of pocket. The portfolio reached $942,000 in the projection. Subtract the contributions, and roughly $887,250 came from compounding, reinvested dividends, and market growth. That is the real lesson. The future wealth did not come mostly from the dollars Josh worked for. It came from the system those dollars entered. That is the 12th principle. The goal is not to make your paycheck bigger forever. The goal is to build assets that eventually work harder than the paycheck. This is what passive income really means. But people often misunderstand the word passive. There is nothing passive about the early years. The early years require discipline. The weekly deposits require consistency. The patience requires emotional control. The portfolio must be fed before it can feed you. The income becomes passive only after the system has been built. People want the $8,000 a month. They do not want the 30 years of $35 a week. But those two things are connected. The monthly income is the result of the weekly habit. That is the 13th principle. You do not get the outcome without becoming the kind of person who can repeat the input. Now, the idea that $35 a week can surpass a full-time job is powerful because it changes how people think about income. A job pays because you work. A portfolio pays because you own. A paycheck stops if the work stops. A portfolio can continue producing dividends if the assets remain healthy and distributions continue. A paycheck depends on time, employer, salary, and energy. A portfolio depends on capital, ownership, yield, growth, and time. At first, labor income builds the portfolio later. The portfolio begins supporting the person who built it. That is the 14th principle. Labor income pays you for effort. Asset income pays you for ownership. This is why small weekly investing is not small in meaning. The amount is small, the identity shift is large. You stop being only a consumer, you become an owner. Every week you turn a piece of labor into a piece of productive capital. Most people dismiss small amounts because they want big visible moves. But small amounts repeated for decades can beat large intentions that never become action. That is the 15th principle. Small numbers repeated consistently can beat large plans delayed forever. A person may say, I will invest when I have more money. But later becomes next year becomes 5 years becomes a decade. Then they look back and realize the missing piece was not intelligence, it was repetition. Weekly investing removes that delay. It does not wait for perfect conditions. It begins with the cash flow you have. If you cannot invest $35 a week, start smaller, $20, $10, $5. The point is to build the habit and increase it when capacity improves. If you can invest more, do more. $70 a week changes the curve. $100 a week changes it again. But do not create a contribution level that collapses under stress. The 16th principle, a sustainable contribution is better than an impressive contribution that fails. Now consider the role of emergency cash. The source focuses on investing, but the larger system must include liquidity. If every emergency forces you to sell investments or use high-interest debt, the plan becomes fragile. A portfolio should not be the only safety net. Cash for emergencies. Investments for long-term growth, debt control, income growth. These pieces work together. If a person carries high-interest credit card debt, paying that debt may be more urgent than investing aggressively, because the interest rate can exceed expected market returns by a wide margin. If debt is manageable and the weekly contribution is small enough to maintain, both debt reduction and investing may happen together. That is the 17th principle. A good investing habit must sit inside a stable financial system. Now consider risk. A portfolio of stock funds can fall. Even diversified funds can decline sharply during bear markets. If you cannot tolerate seeing the account down, you may stop contributing at the worst time. The weekly investing plan assumes you keep buying through downturns. If you stop whenever markets fall, the model changes. That is the 18th principle. The return you earn depends on the behavior you keep during bad markets. Historical returns belong to investors who stayed invested. The market does not give its long-term return to people who only enter after everything feels safe and exit whenever headlines become frightening. This is why automation helps. Automation is courage built in advance. You decide before panic. Then the system continues when emotion becomes unreliable. Now think about dividends again. During the accumulation phase, reinvested dividends are workers you send back into the field. If you spend dividends too early, the snowball grows more slowly. If you reinvest them, they buy more shares. Those shares can produce more dividends over decades. That loop becomes powerful. Dividend growth makes the loop stronger. A starting yield of 2.19% does not sound huge. But if dividends grow and are reinvested, the income stream can become meaningful over time. That is the 19th principle. The power of dividend investing is not only income today, it is income that can buy more future income. This is why low fees matter again. Every fee is a drag on that loop. Every unnecessary cost removes dollars that could have bought more ownership. Taxes matter too. If these funds are held in a taxable account, dividends may be taxable, capital gains may be taxable when sold. If held in a Roth IRA, traditional IRA, 401k, or other tax-advantaged account, the tax result may differ. The account is part of the investment system. That is the 20th principle. The fund matters. But the account holding the fund also matters. A good fund in the wrong tax or behavioral structure may not produce the same result for the investor. Now think about inflation from the owner's point of view. If you only consume, inflation hurts you. If you own productive assets, you may participate in the companies that raise prices, grow earnings, and pay dividends. You are not only paying the economy anymore, you are owning pieces of it. That is the 21st principle. The best defense against rising prices is not only earning more, it is owning assets that can grow with the economy. This is the real shift. A paycheck is necessary, but if the paycheck is never converted into ownership, the person remains trapped in the linear world. They work, get paid, spend, and repeat. The portfolio introduces the nonlinear world. The money earns. The earnings reinvest. The base expands. The future earnings become larger. Labor is linear. Compounding is exponential. The goal is to use linear income to build exponential assets. That is the 22nd principle. Now, a serious investor must not treat the Fidelity example as a guarantee. The source projection depends on strong assumptions. It assumes long-term growth, reinvested dividends, and sustained portfolio behavior. Future results can be lower. Some funds may lag, dividend policies can change, markets can underperform. Inflation can reduce real purchasing power, but uncertainty is not a reason to do nothing. If the final number is lower than $942,000, the investor may still be far better off than if the money had been spent invisibly every week. That is the 23rd principle. A lower than projected result can still be far better than no result. Do not allow uncertainty about the exact number to stop you from building the right behavior. Now think about the practical routine. Open or use an investment account. Choose the weekly contribution, $35 if possible. Less if necessary, more if possible. Choose a simple, low-cost, diversified structure. Set the allocation. Turn on recurring investments if available. Turn on dividend reinvestment. Review periodically, not obsessively. Increase the contribution when income rises. Do not stop because the first years are boring. Do not stop because the headlines are frightening. Do not stop because the balance looks too small. That is the 24th principle. A portfolio is built by rules you follow when you do not feel like following them. Anyone can invest when excited. The real investor continues when bored, scared, busy, or distracted. Now consider the 5 funds as parts of one machine. FZROX gives broad U.S. market exposure and zero fees. FSMDX adds mid-cap growth and companies still climbing. FITLX adds sustainability, screened and future-oriented growth exposure. FGRIX adds quality large-cap growth and income. FDGFX adds dividend growth and income stability together. They create a structure that tries to combine growth, income, diversification, and low cost. This is not the only possible portfolio. It is a framework. Some investors may use fewer funds. Some may use different weights. Some may prefer a total market fund alone. Some may adjust based on age, risk tolerance, taxes, and account type. The key is that the portfolio must be understandable and maintainable. That is the 25th principle. The best portfolio is not the one that looks smartest on paper. It is the one you can actually hold for decades. A complicated portfolio that you abandon is worse than a simple portfolio you maintain. Now let us look at the emotional side. If you feel behind, it is easy to believe small action is pointless. But small action is exactly how the base begins. The same time that makes food more expensive can make assets more valuable if you own them. The same economy that pressures your paycheck can produce profits for companies. If you own pieces of them, the same volatility that scares others can help you accumulate more shares if your weekly system continues. The world is not calm. It never will be. The question is whether your system requires calm. A weekly investing system does not. It requires repetition. That is why it is powerful. The 26th principle: you do not need a perfect world to build wealth. You need a system that continues inside an imperfect world. Now I will put the whole system into one chain. Inflation weakens idle money. Wages often lag rising costs. Interest rates make borrowing feel heavier. Markets crash. But historically, they have recovered and moved upward over long periods. Weekly investing removes the need to time the market. Small deposits create the base. Reinvested dividends add weight to the snowball. Low fees protect compounding. Diversified Fidelity funds can create broad exposure to growth and income. Under the source, assumptions, a $35 weekly habit can grow toward a portfolio near $942,000 over 30 years and potentially produce around $8,000 per month in dividends. The number is not guaranteed. The principle is real. Consistency plus ownership plus time can change the financial direction of a life. This is how I would think about it, not as a get-rich-quick promise, not as magic, not as certainty, as a system. Your paycheck is linear. Your expenses are rising, your investments can compound. The bridge between those realities is the habit of turning part of every paycheck into ownership before life consumes it. That habit can begin with $35 a week. At first, it will not look impressive. That is normal. The first few years will not look like the final projection. That is normal. The market will fall sometimes. That is normal. The headlines will scare you. That is normal. Your job is not to make the market calm. Your job is to keep the habit alive. Because one day, if the system works and you stay with it, the portfolio may begin producing income that looks nothing like the tiny weekly deposit that started it. That is the point. You are not just investing $35. You are buying future ownership. You are buying time working for you. You are buying a chance to build income that does not require another hour from your life. And that is one of the most important financial shifts a person can make.